3 mistakes. Each one can cost you tens or even hundreds of thousands of dollars in retirement, and not one of them feels like a mistake when you make it. They feel responsible, they feel smart. That's the trap. I've watched engineers, physicians, business owners, people who did everything right on the way up, hand the IRS an extra decade of taxes on the way down. By the end of this video, you'll be able to spot all 3 in your own plan. For those of you retiring early, the third one is absolutely brutal, and the one almost nobody talks about, and it quietly breaks the other 2. Let's jump into the video. I'm Ryan Knoll, founder of Nav Wealth Partners. We do one thing: retirement tax planning and investment management for households who've done the hard part. You saved, and now you need to make sure you keep what you earned instead of handing an extra decade of taxes to the IRS. This channel is about the strategy that happens after the nest egg is built. Let's jump into the 3 mistakes that we see most often here at Nav Wealth. The first mistake I call the corridor collision. There are 2 enormously powerful tax strategies available in retirement, and they both live in the same low income years, and they fight each other in any given year. People try to do both at once, do neither well, and walk away thinking, hey, we did some tax planning, but they left a fortune on the table. The 2 strategies are the Roth conversion corridor and the capital gains harvesting window. Let me define each, then I'll show you the collision. The Roth conversion corridor. This is the gap between when your paycheck stops and your income gets forced back up by Social Security, and especially by your required minimum distributions at 73 or 75. In that valley, your taxable income might be low, so you deliberately fill up the lower taxable brackets by converting traditional IRA money to Roth, paying that tax now at a known lower rate to avoid a much bigger forced tax bill later on when RMDs hit. You're voluntarily generating income to convert. The capital gains harvesting window, on the other hand, is what we're going to talk about next. And here's the part that retirees often ignore. There is a 0% federal tax rate on long-term capital gains as long as your taxable income stays below a threshold. In those same low-income years, you can sell appreciated investments in your brokerage account, pay literally 0 federal tax on the gain, and immediately rebuy to reset your cost basis higher. You're keeping income low to stay in that 0% band for the rest of your life. Now do you see the collision? If you don't, that's okay. I did an in-depth overview in a recent video. It's called Your Brokerage Account Can Be a Roth. Here's how. It's linked below. Go check it out. It'll be worth the 30 minutes of your time. The Roth conversion strategy says pump income up to fill the brackets. The capital gain strategy says keep income down to stay in the 0% zone. These 2 goals are fighting over the same dollars of income headroom in the same calendar years. You physically cannot maximize both in one year. Every dollar of Roth conversion income pushes you out of the 0% capital gains rate. Every dollar of capital gain you harvest eats up room you could have used for conversions. The mistake, or the collision, is doing a little of each every year, blending them into mush. A small conversion here, a little gain harvesting there. You blunt both strategies. You get a mediocre conversion in a half-used 0% bracket. The fix is sequencing, not blending. You don't do both every year. You assign each year a job. Let me make this real. Picture a couple retiring at age 60. RMDs start at 75. That's a 15-year corridor. The amateur move is to do a uniform conversion every year for 15 years and call that a plan. The professional move segments it. Some years are designated harvesting years, where you keep income low and pull appreciated gains out at 0%. Other years are designated conversion years, where you pivot hard and fill the brackets with Roth conversions, accepting that you're giving up the 0% rate that year on purpose. And there's a ceiling to respect in the conversion years, IRMAA, the Medicare Premium Surcharge. Once you're 63 and older, your income feeds your Medicare premiums 2 years later. So your conversion years have a ceiling, but that's a line you manage on purpose, not one you blend across by accident. That's the difference between a collision and a corridor strategy. Same tools, completely different outcomes. The household that sequences these can convert hundreds of thousands more to Roth and harvest more gains at 0 tax because they did them in the right years instead of all at once. But here's the thing, and keep this in your back pocket. None of this sequencing even works unless your accounts are physically set up for it, which is mistake number 2. And the second mistake I call the accumulation hangover. Here's the core idea. The way you organize your money to grow it is the wrong way to organize it to spend it. People carry their accumulation era habits into retirement like a hangover, and those habits silently sabotage the corridor strategy I just showed you. This shows up in two connected ways: asset location and withdrawal sequencing. Asset location first, not asset allocation. That's your stock and bond mix. Asset location is which account holds which investment. During your career, the standard advice is to dump everything everywhere. Max the 401k, max the IRA, maybe do a backdoor, throw money in the brokerage. Don't overthink which holdings sit where. For accumulation, that's mostly fine. In retirement, location becomes a tax lever. The principal, tax inefficient assets, bonds, REITs, anything throwing off ordinary income, belong in your tax deferred accounts. Your traditional IRA and your 401k. Your highest growth assets, stocks you expect to appreciate a lot, those belong in your Roth, where that growth is never taxed. And your taxable brokerage account wants tax-efficient holdings. Broad index funds, individual stocks you can control the gains and capture the losses as they arise. Now watch how this connects straight back to mistake number 1. Capital gains harvesting in the 0% bracket, that only works on assets in your taxable brokerage account. If all your appreciated growth is trapped in your IRA, you can't harvest it at 0%. It all comes out as ordinary income. The accumulation era habit of not caring where things sit just destroyed your harvesting window. Same with Roth conversions. The value of converting depends what grows tax-free afterwards. If you've got your slow, boring bond fund in the Roth and your rocket ship growth stock in the IRA, you've got it exactly backwards. You convert, then watch the tax-free account barely grow while the taxable later account compounds. Now, withdrawal sequencing, the second half of the hangover. During accumulation, the question was, where do I put money? In retirement, it flips. Where do I pull money from and in what order? The naive default, the hangover, is to spend the taxable first, then tax deferred, then Roth last, because that's the old rule of thumb everybody repeats. It's not wrong exactly, but applied blindly, it collides with your corridor. The sophisticated version is your withdrawal sequence has to serve your corridor strategy. In your harvesting years, you pull from sources that keep income low. In your conversion years, you're deliberately pulling and converting from the traditional IRA to fill brackets. The accumulation brain retiree thinks, I have $3 million, I'll just spend it. The distribution brain retiree thinks, which specific account in which specific year funds this specific dollar? And how does that interact with my conversion, my gain harvesting, and my future RMDs? That's the whole game. Mistake 1 gives you the strategy. Mistake 2 is whether your balance sheet is physically able to execute it. Reposition assets by tax character, map your withdrawals to your corridor years, and treat the whole thing as one big machine. Let me pause here, because this is exactly the kind of thing that's almost impossible to DIY. Sequencing harvesting years against conversion years, locating assets so the strategy even works, respecting the IRMAA ceiling, all while drawing down to actually live on, that's a multi-year choreography where every year depends on the last. This is the entire reason Nav Wealth Partners exists. We believe taxes are the greatest drag on a retiree's wealth, and we help develop a plan and implement an investment strategy to reduce their impact. If you want to know whether your corridor is being used or wasted and have your portfolio managed to maximize your space, the booking link is in the description. If that's you, grab one of the spots. Now to the third mistake, the one that throws everything we just went over out the door and applies its own set of rules. The third mistake I call the Subsidy Cliff Blindspot, and I saved it for last because it's the most time sensitive of the three. The law changed this year and most people have no idea. Here's the setup. You retire early. Think like age 60, age 62, somewhere in there, maybe a bit younger. The idea is you're not 65 yet, so Medicare isn't available. You need health insurance for the gap years. You price coverage. You see a number like $1,400, $1,600 a month. You wince, but you write the check. Or you buy an off-exchange plan and never even look at the marketplace. That decision, made in an afternoon, can cost you tens of thousands of dollars a year until Medicare. And here's why. The ACA provides premium tax credits, subsidies that lower the cost of your health insurance. Most high earners assume those are for low-income people. That's not me. I've got $3 million or more. But here's what breaks people's brains. ACA subsidies are based on your modified adjusted gross income, not your net worth. The subsidy is calculated off your modified adjusted gross income for that year. It does not care that you have $3 million sitting in accounts. It cares what shows up on your tax return. In an early retirement, before Social Security, before RMDs, you have extraordinary control over your taxable income. You might have millions in assets and choose to show $70,000 or $80,000 of income. For ACA subsidies, modified adjusted gross income is calculated by wages or self-employment income, plus taxable Social Security, plus traditional IRA and 401k distributions, Roth conversions, capital gains, dividends, and interest, all added up. Now here's the part that changed, and you need to hear it clearly. The enhanced premium tax credits that ran from 2021 through 2025 expired at the end of 2025. As of January 1st, 2026, the subsidy structure reverted back to the original ACA framework. Credits are available only up to 400% of the federal poverty level, and the subsidy cliff is back. What does that mean in real numbers? In 2026, the federal poverty level is $15,960 for an individual and $21,150 for a couple. At 4 times those amount, or 400%, that's $63,840 for an individual and $84,600 for a couple. Go over the 400% level and you receive no subsidy at all. I'm going to switch and share my screen now to go over exactly what this looks like for a couple who is showing modified adjusted gross income of $45,000 before they make any decisions on how they're going to fund their lifestyle. We'll see the different trade-offs of funding it from a traditional IRA, from their brokerage account, or from a Roth. But stay tuned, because this is where the biggest mistakes get made. All right, so first things first is we want to make sure we have a good handle on what the federal poverty line is for individuals or for couples that get into retirement. So just in this example, we're going to go over how this works for a married couple. So where you want to start is on this table is in the left-hand column where it says number of people in household. So we know that a married couple would have 2 people in their household, and the 100% federal poverty line limit is $21,150. So that's just the baseline where we're starting. And then the 400% poverty level limit is $84,600. So just 4 times that amount. So what you're going to want to do is you're going to want to see where your modified adjusted gross income falls, like we defined it as earlier, where it falls on this table. So for somebody who has $45,000 in modified adjusted gross income, they would be between the 200% federal poverty level and the 250% federal poverty level, which means when we look at this table on the bottom, this would be their expected contribution from as a percentage of their income towards their ACA coverage plan premium. So somebody who had a $45,000 of modified adjusted gross income would need to pay roughly 6.6% of that income towards their Medicare in order to receive coverage, and the rest would be covered by subsidies. So let's just go over some numbers a little bit more exactly here on the next page. So here we have that couple, $45,000 modified adjusted gross income. Their federal poverty line is 207%. So putting that back on the table here, it's slightly above the 200% level, but not quite to the 250% level. So we're going to pay 6.55% or 6.6% of income towards Medicare premiums in the year. So if we benchmark this against a silver plan, which is this line item right here, the annual cost all in for that is just shy of $32,000. It's $31,828. Now their required contribution of that is 6.55% of their $45,000 modified adjusted gross income. So they would receive, or so they would pay, in other words, a little less than $2,950 a year or $246 a month, and the rest would be a federal subsidy. So the government in this instance is picking up the majority of the costs here for their premium plan. But let's change around a little bit the assumptions. So we know that baseline modified adjusted gross income, this is things from like interest and dividends, maybe some IRA distributions they're doing, is about $45,000. But let's say the client needs $45,000 a year to live on. So where do we pull that other $45,000 from to make sure they have enough money to live on for the year? So they really have 3 options. So option 1 is they could pull from their IRA. This is going to increase their modified adjusted gross income dollar for dollar. It's going to increase the taxes they pay, and they're going to receive a lot less of a subsidy. They could pull from their brokerage account, and that could be potentially tax-free, or they might pay some small capital gains tax on it, depending on how high they go. And their ACA subsidy, they're going to receive less because they're claiming more income. But is it going to be quite as much of a reduction as it would be from option 1? We don't know. That's what the rest of this analysis is going to be. And then there's the ability to pull from Roth, which has no baseline impact on modified adjusted gross income, no baseline impact on your tax implication, therefore no change to your ACA subsidy. So let's walk through a couple of examples. I'm going to look at the tax perspective first. So we're going to switch screens here. And let's say we have a married couple who makes $45,000 a year of modified adjusted gross income. And in scenario one, we're going to look at pulling from the IRA. So this couple has $10,000 in taxable interest. That's just from interest on CDs and cash accounts, savings accounts that they might have. That's contributing towards that modified adjusted gross income number. They also have qualified dividends of $35,000. And let's say that this couple, we're going to change this back here because we're going to go to the $80,000 example in a minute, pulls the other $45,000 they need to meet their $90,000 spending need from their IRA. So when we look at the tax report for this client, it's going to be relatively simple. But there's a couple key things that are happening here, even with a relatively simple decision. So we know that total income is $90,000. They're going to take the standard deduction of $32,200, which leaves them with taxable income of $57,800. That's just the difference between their deductions and their adjusted gross income. Their total tax in this instance is $2,280. So slightly less than $2,300, but that's all they're paying in federal taxes, right? So, they pulled out 90, they're paying about $2,300 in taxes. So they're almost at their spending need for the year. They could pull a little bit more out of their IRA if they need to. But I just wanted to show you what that extra $45,000 of income from their IRA would look like. Here's how that's taxed. They have roughly $22,800 on the 10% bracket, which is just their interest in the IRA distribution less their standard deduction, which is accounting for all of that tax. Their qualified dividends and long-term capital gains, because their taxable income is below $98,900. They have $35,000 of qualified income, but they pay no tax on it because they're in the 0% taxable income threshold bracket. But what I want to point out is what often gets missed when people do these traditional IRA distributions to meet their spending needs is they're increasing their modified adjusted gross income. So when we look at here, modified adjusted gross income for ACA premium credit, it's $90,000, which puts them over the 400% federal poverty limit, which means they now have to pay for all of their ACA healthcare coverage. So if we go back to the other screen, what actually happens here? So in scenario one, this is their baseline. Before they do any IRA withdrawal, they take out $45,000. They're at 207% federal poverty level. They're eligible for subsidy, and their annual subsidy is just shy of $29,000. But after their withdrawal, they're at $90,000 of modified adjusted gross income. That's 414% of the federal poverty level, which means they're not eligible for that subsidy anymore, which means they don't have any coverage from the government. And they have to pay an additional $28,880 on top of the taxes. So now they actually have a shortfall. Their spending needs are about $34,000 short after you account for the increased subsidy costs and the taxes that they have to pay, which now necessitates the need to withdraw about $80,000. But I want to show you what happens here when they lose the ACA subsidy, when they take out an additional taxes for the IRA withdrawal, their taxes go up. Their ACA subsidy is lost, and they really only gain in value, take-home value, a little less than $11,000 from this distribution. So about 24 cents on the dollar. This is like the worst possible scenario for somebody who needs to spend more money. So what they would have to do under scenario one, and we're going to go back here for a second, they would need to take out $80,000. And we'll just say that the husband takes out all of it just to keep it simple. In actuality, it'll probably be a combination of the two, but just for example's sake, it doesn't really matter who's taking it. So what they have to do now is they're pulling out that $80,000. So when we go back to the tax report, we know that they now have $125,000 of total income. Their taxes are $6,400, so let's just round that to $6,000. They have about $119,000 left after taxes are paid, and their ACA subsidy went up by about $29,000, so you subtract that as well. And now they have the $90,000 that they need to spend and to even count for the additional ACA premium that they have to pay. So in all actuality, their costs went up by about $33,000, and they needed to pull even more from their IRA that can't be tax advantaged now through Roth conversions or income sequencing just to cover their baseline costs. So that's option one, probably not the best use of funds. So let's close out of that now and then move to option two. So option two says we'll pull from the brokerage account.
So new total modified adjusted gross income here would be $60,000. And I know what you're thinking. How is modified adjusted gross income lower? Well, when you pull from a brokerage account, not everything that you pull out is taxed. You're only taxed on the capital gains. So let's say that this couple can pull out $45,000 of cash or proceeds from their investment account, but it only results in $15,000 worth of capital gains. Those capital gains are what gets added to the modified adjusted gross income. So at this point, they're at the 276% federal poverty level, which means their subsidy decreases from $28,880 at their baseline to $26,458. So they're going to be short in this instance, only $2,422 a year from the ACA subsidy standpoint. Let's look at what this looks like from the tax standpoint now. So if we go here, and just to show you, we're looking at a different example. So we're pulling from the brokerage account. We have the same $10,000 of taxable interest, the same $35,000 of taxable or of qualified dividends rather, and capital gains, long-term capital gains of $15,000. So when we go and we plug this into the tax report, here's what that looks like. We have the same $60,000 of total income, or this is going to be the same as the modified adjusted gross income. They're claiming the standard deduction of $32,200. Their taxable income for the year is $27,800. Of that taxable income, only $10,000 is due to ordinary income sources, which is the interest that they earn on their cash and their CDs. So that's going to be eaten up by the standard deduction. So they owe nothing on the ordinary income table. Now we want to look at the capital gains and the long-term qualified dividends table as well. Their qualified income here is $27,800, which is just their total taxable income, which is still in the 0% tax bracket. So they owe nothing in the way of dividend tax either. So total tax due from a federal standpoint in this scenario is $0. So there's no incremental increase in taxes here. And then when we look at their ACA subsidy, which is all the way at the bottom here, we'll see, $60,000, 284% of the federal poverty limit, which is exactly what we had on the last screen there. So then you see all they really are short is this $2,400 they lost in ACA subsidy. So what we're seeing here is the change in all of this. So the brokerage account, this scenario is a little bit better in this than pulling from the IRA because their total modified adjusted gross income would be $30,000 lower, which allows them to have an annual subsidy of around $26,500. They're going to pay a little bit more on their monthly premium over the baseline, about $448, but it's still $2,200 less than what they would have paid if they did an IRA withdrawal. There's no incremental tax increase. And the net value of pulling out that $45,000, they're going to pocket about 95% of it, $42,578 versus the $10,920 that they would pocket after their IRA withdrawal. So between option one and option two looks like a better alternative. We're going to talk a little bit about option three, which is the Roth side in a little bit here. And then we're going to compare all three. I do like the brokerage account for this client, as just a little spoiler alert before we get into the latter half of the presentation. But this just goes to show you how nuanced this type of planning is.
Moving on to option three. If they were to pull from their Roth, there would be no impact. ACA subsidies would stay the same. Tax liability stays the same. Why? Because Roth distributions do not impact modified adjusted gross income. But I would still gravitate towards taking the money out of the brokerage account. Roth dollars are very valuable, especially those that compound over 20 or 30 years. So leave them alone as long as possible. The brokerage account is another $2,500 a year in ACA subsidies lost, but that is much more manageable than pulling from the IRA. And now watch everything in this video snap together. Remember mistake number one, the corridor collision? Here's the third combatant I held back. In your pre-Medicare years, the ACA subsidy says keep income down, even further down than capital gains harvesting requires in some instances. So a Roth conversion in those years isn't just taxed. It can blow your subsidy on top, a hidden surtax on every converted dollar. This is why the corridor has to be sequenced. Your pre-65 years lean toward harvesting and subsidy capture. Your post-65 years, once the ACA cliff no longer applies, are when you pivot hard to conversions. And mistake number two, the accumulation hangover. It's why you can even pull this off. To live on a low taxable income in your ACA years while still funding your lifestyle, you need to draw from accounts that don't spike your modified adjusted gross income, your taxable brokerage, and your Roth. If your money is located wrong and your withdrawals are on autopilot, you can't suppress your income enough to catch the subsidy. no matter how well you understand the cliff. That's the whole picture. 3 masks, 1 face. One honest caveat to put on screen. There's active discussion in Congress, the CARE Act framework, about restoring subsidies with new guardrails like a $200,000 income cap. Plan for the rules as they exist today. If they change, then we adjust. Don't build a plan on a bill that has not yet passed. So there they are, the 3 worst retirement mistakes that I see. 1, the corridor collision. Doing Roth conversions and capital gains harvesting at the same time every year, instead of sequencing them into the right years. 2, the accumulation hangover. Carrying your savings era habits into your spending years with assets located wrong and withdrawals on autopilot, which quietly disables your whole strategy. 3, the subsidy cliff blindspot. Forgetting that ACA subsidies are driven by the income you control in early retirement, and the cliff is back and brutal as of this year. They're not 3 separate problems, they're one problem wearing 3 masks. The failure to realize that retirement is a different game than the one that got you here. Accumulation built the pile. Distribution decides how much you keep. If this opened your eyes, hit subscribe. That's the planning we do in every episode. And if you want our team to map your specific corridor, the booking link is in the description. We only take a handful of households each month. So if you're a fit, reach out.